Welcome to vTalkInsight, Market Drivers Daily for June 26, 2026. AI is still the dominant growth engine, but today it collides with stretched tech valuations, record single-stock volatility, and a surprisingly calm oil market despite fresh tension in the Strait of Hormuz. Let's unpack what that mix could mean for risk assets into the summer. AI remains the central macro and equity story, but the narrative is shifting from a simple growth tailwind to a more complicated repricing across the value chain. Capital expenditure is surging, margins are under strain for some large tech names, and markets are starting to draw sharper distinctions between infrastructure suppliers, big spenders, and business models that may not justify their valuations. Forecasts for hyperscaler capital expenditure on AI infrastructure have been revised sharply higher, from around 30% growth this year toward 90%, underscoring how fast the build-out is accelerating. Rising memory prices and component costs, highlighted by Micron's very high margins and Apple's AI-related cost concerns, are squeezing budgets for these platforms and forcing some companies to raise end-product prices. That in turn feeds worries about goods inflation in technology, a sector that historically helped pull prices down rather than push them up. The equity market is now rewarding the recipients of AI Capex more than the spenders. Stocks tied to semiconductors and IT hardware, particularly in areas like high-bandwidth memory, have driven most of this year's S&P 500 gains, while hyperscalers and some software names lag as their heavy investment funds the boom. In Asia, South Korea's market illustrates the risk. A tripling of the Kospi, heavily concentrated in a few AI chipmakers, has been followed by violent downside moves and trading halts, fueling concerns that parts of the AI trade already look bubble-prone. Competition is also reshaping where value is captured in AI. Chinese open-source models have rapidly gained share, rising from about 20% of usage to around half in a year, while U.S. models lost ground, which challenges the pricing power of expensive, closed systems. At the same time, increasing government intervention, such as pressure to stagger model releases and fading retail enthusiasm for AI-related IPOs, are complicating capital raising. OpenAI's efforts to protect a $1 trillion valuation, combined with tech sector volatility, have already led to talk of delaying its listing toward 2027, raising questions about how it will fund rapid ecosystem expansion amid high cash burn. Set against those risks is a powerful productivity story that anchors the longer-term bull case. AI-driven efficiency gains are already showing up in real businesses, with examples like a roughly 25% increase in revenue per employee at an aerospace and defense company, and traditional retailers outperforming peers by integrating AI more effectively into operations. Strategists expect AI to lift economic activity by about 25% by 2030 and require roughly 5 times last year's compute capacity, with the semiconductor market projected to approach $2.7 trillion by the end of the decade. That growth will demand far more power and resilient grids, which is accelerating investment in domestic, clean baseload sources such as geothermal and reinforcing the broader U.S. re-industrialization theme. So the near-term picture is one of tension. Medium-term downside risks for crowded AI trades sit alongside a still early infrastructure cycle and widening dispersion between winners and laggards. As that tension builds, price swings around AI narratives have become more extreme, feeding directly into today's volatility backdrop. Market volatility is elevated, but it is increasingly concentrated in technology, single names, and leveraged structures rather than broad indices. In the United States, extreme moves in large tech stocks are being driven by concentrated retail activity, heavy call option buying, and record margin balances, while massive flows into leveraged semiconductor and tech ETFs amplify both rallies and sell-offs. Single stock volatility has pushed to record levels versus indices, underscoring how idiosyncratic risk now dominates index-level swings. South Korea sits at the epicenter of this dynamic. The Kospi's sharp declines of around 6 to 7%, repeated circuit breaker triggers, and trading suspensions in major chip makers show what can happen when a rally is powered by retail leverage and concentrated AI chip exposure. Those moves have spilled over into European futures, with the DAX and stocks benchmarks opening lower, and into U.S. markets where Nasdaq futures and cash indices have seen back-to-back losses led by semiconductors and hyperscaler-related names. Yet the overall picture is not one of outright panic. Despite a record-setting trading month and heavy selling in technology, Nasdaq 100 futures are only modestly lower, and the S&P 500 has shown the ability to reverse intraday losses and trade higher, reflecting residual risk appetite supported by AI Capex and hopes of Middle East conflict resolution. In rates, front-end Treasury yields have rallied for several sessions, with the 2-year moving toward 4.1%, while gold is increasingly used as a portfolio diversifier and as a substitute for longer-duration treasuries amid concerns about correlation breakdowns. Policy uncertainty is adding another layer of volatility. The Federal Reserve's reduced reliance on forward guidance and ongoing balance sheet reduction have increased noise around the policy path, and there are warnings that any renewed push to shrink the balance sheet aggressively could trigger another bout of asset price instability. At the same time, markets are bracing for a choppy summer as they reassess how sustainable AI-driven earnings really are and how much tightening the economy can absorb. Against that backdrop, some institutional investors are looking at tail risk hedges in equity indices and credit as a way to manage downside scenarios, taking advantage of volatility pricing that still looks relatively contained versus recent realized swings. Specific events are set to keep volatility elevated. The annual Russell Index reconstitution is expected to affect more than 200 companies joining the Russell 2000, likely increasing turnover and short-term trading in small caps and related ETFs. In single names, SpaceX is a focal point, with its inclusion in the Nasdaq 100, the dominance of fast money investors in its recent bond deal, and the expiry of retail anti-flipping restrictions, all pointing to the potential for sharp price moves as index funds and early buyers reposition. Crypto adds another pressure point, with Bitcoin hovering near key technical support around $59,000 and some analysts flagging the risk of a deeper slide toward the low 40,000s if that level breaks. Looking ahead, volatility is likely to remain a central feature as markets juggle AI repricing, event-driven flows, and shifting rate expectations, even while the biggest macro tail risks come from geopolitics and energy. Geopolitical risk around the Strait of Hormuz remains high, yet energy markets are behaving as if disruption risks are contained. Recent attacks on cargo and container vessels, including a Singapore-flagged ship, have prompted some owners to pause or reroute, and insurance costs through the area remain elevated. Even so, oil and liquefied natural gas tankers continue to transit in large volumes. Crude flows have rebounded toward pre-conflict levels, and spot oil prices have fallen sharply, with Brent down roughly 4% to the low 70s. The political backdrop is changing in ways that matter for long-term risk premia. Iran has effectively used the strait as economic leverage, extracting concessions through waivers that allow an estimated 130 to 150 million barrels of oil on the market, while negotiating over potential tolls on shipping. Oman is now reported to be examining its own transit fees, aiming for tens of billions of dollars a year, and there is concern that other countries controlling key waterways could follow, eroding the post-war norm of free global commerce. At the same time, U.S. military power has struggled to guarantee open passage, and broad sanctions have shown diminishing impact on state behavior, which collectively raises the risk that future disputes escalate more quickly. Shorter term, supply dynamics point to continued downward pressure on crude even as refined products stay tight. Despite U.S. crude inventories at their lowest since the mid-1980s, oil prices remain subdued, with experts expecting inventories to start rebuilding from August and potentially tip the market in a surplus through 2027 as producers maximize output. By contrast, cracks for gasoline and diesel are at historic highs, and Europe faces an acute diesel crunch due to shallow Rhine water levels, refinery closures, Russian import bans, and reduced shipment from the Middle East. Europe's heavy reliance on diesel, combined with these logistical constraints, leaves regional inflation vulnerable even as lower headline crude prices offer some relief to manufacturing-heavy economies like Germany. These cross-currents are accelerating investment in the energy transition and domestic supply resilience. Recent security incidents and fee threats in Hormuz are reinforcing the case for more local, sustainable energy sources, with advances in semiconductor and capacitor technology supported by industrial policy, enabling faster and more efficient geothermal drilling. Geothermal in particular is seen as a potential source of scalable baseload power that could meet surging demand from AI data centers and electrification without relying on vulnerable maritime choke points. For markets, the base case now combines softer crude, tight refined products, and slowly improving energy security, but the tail risk of renewed disruption or a shift in choke point politics still hangs over global trade, inflation, and rate expectations. How that risk is priced relative to the AI-driven growth story and today's volatility regime will be a key theme for the second half of the year. To sum up, the AI build-out remains the primary growth engine, but soaring Capex, rising input costs, and intensifying competition are forcing a rethink of who really captures value across the stack. Volatility has migrated from indices into single-name tech, leveraged products, and event-driven flows like index rebalances, creating an environment where positioning and risk management matter as much as macro views. Meanwhile, geopolitical risks around the Strait of Hormuz are structurally higher, yet crude prices are sliding as flows stay resilient and inventories are expected to rebuild, leaving a wide range of outcomes for inflation and policy rates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.